good day to everyone. Today we will be presenting our analysis of non-current asset in Teck Plantation Berhad based on its 2024 annual reports and how it complies with relevant Malaysian financial reporting standards.
The aim of our presentation is to evaluate how Teck identify, measure and disclose its non-current asset in line with 6 key MFRS standards: MFRS 116 on PPE, MFRS 141 on biological asset, MFRS 140 on investment property, MFRS 138 on intangible asset, MFRS 137 on provision, and MFRS 15 on revenue. We will also look at how internal factors like economic condition affect asset value and highlight key financial ratio related to asset efficiency. Teck Plantations Berhad is a Malaysian public listed company involved in the cultivation of oil palm and the production of crude palm oil, CPO, fresh fruit bunches, and a palm kernel. The company operates in both Malaysia and Indonesia and also has investment in land and property development. As a plantation-based company, it holds a large amount of long-term, making accurate and transparent asset reporting extremely important.
Look how Teck applies MFRS 116, which govern property, plant and equipment. Teck used the cost model under paragraph 30 of MFRS 116. This means their assets are recorded at original cost minus accumulated depreciation and impairment losses. This model provides consistency and is less violent than the revaluation model. Their PPE includes freehold land, estate infrastructure, buildings, machinery and motor vehicles. These are essential for plant and mining operation. Depreciation is charged using the straight line method with useful life ranging from 50 years for building, 20 years for machinery and 5 years for motor vehicle. As for financial year for 2024, the net book value of PPE was RM248.3 million, reflecting ongoing investment in estate, development and infrastructure. A key point to note is capital work in progress is not depreciated until it's ready for use. This aligns with the recognition principle in MFRS 116, which required the asset to be capitalized only when the future economic benefit are probable and the cost is reliably to be measured. Using the cost model provides stability in reporting, although it may understate current market value. Teck approach reflect a conservative but reliable accounting policy. Next, let us explore MFRS 141 agriculture, which is especially important for plantation company like Teck. This standard required biological assets such as oil palm tree to be measured at fair value less cost to sell, not at cost. This gives a more realistic estimate of asset economic value. Teck uses a discounted cash flow (DFC) model to estimate this fair value. The model considers such as expected yield per hectare, forecast price of CPO and palm kernel, production cost and a suitable discount rate based on market condition. As per financial year 2024, the fair value of biological asset was RM180.7 million with gain of 13.2 million compared to the previous year. This increase was driven by the better commodity prices and improved estate productivity. It's important to understand that this valuation introduces volatility because market prices and assumptions can change significantly year to year. However, it provides users of financial statement with a more transparent view of the company asset value.
Under MFRS 114, investment properties are measured using the fair value model. For Teck Plantations Berhad, the investment properties mainly consist of undeveloped land parcels held for future capital acquisition and potential development project. As at 31 August 2024, the fair value of these properties was valued at RM 19.6 million, which remained unchanged from the previous financial year. This suggests that either a formal revaluation was not performed during the year or the market value of the property stayed consistent. In line with the requirement of MFRS 114, any gain or loss arising from change in the fair value of investment properties are recognized directly in the income statement. Let's also briefly review several other applicable accounting standards. MFRS 137 Provisions, Contingent Liabilities and Contingent Assets. Teck Plantations Berhad did not record any material provision or contingent liabilities for financial year 2024. However, the company acknowledged its obligations, particularly for environmental rehabilitation if required in the future. This is in compliance with MFRS 137, which requires companies to disclose or recognize provisions when a legal or constructive obligation exists. MFRS 138 Intangible Asset for financial year 2024, Teck Plantations Berhad did not report any material intangible asset. This implies that items like software or license are not capitalized under property, plant and equipment rather than recognized as separate intangible asset, as they are not significant for the financial position. MFRS 15 Revenue from contracts with customer. Revenue from the sale of crude palm oil, CPO and palm kernel PK is recognized when control of the goods transferred to the buyer, which typically occurs upon delivery. At this point, the risks and rewards of ownership pass to the customer. The revenue is measured at the fair value of the consideration received or receivable, net of any discount and tax. Importantly, no significant financial component or deferred consideration was identified for these transactions in final year 2024.
In 2024, several economic factors impacted asset valuation. Labor shortage due to foreign worker constraints led to rising estate maintenance costs. In response, Teck invested in mechanization and replanting programs to maintain productivity. CPO price fluctuations also influenced the valuation of biological assets. Despite these challenges, the company adopted conservative assumptions to ensure fair value reliability. Now, let's dive deeper into Teck's key financial ratios for financial year 2024, which help us evaluate how efficiently the company managed its non-current assets. First, the return on assets or ROA is 16.83%. This means for every RM1 of total assets owned by the company, it earns about 17 cents in net profit. This is a strong performance, especially for a capital-intensive sector like plantations, where fixed assets like land and infrastructure dominate the balance sheet. The high ROA also reflects operational efficiency and profitability. Second, we have the asset turnover ratio, which is 0.43 times. This indicates that Teck generated approximately 43 cents of revenue for every RM1 of total assets. This figure might seem low compared to trading or service companies, but for plantation companies, which require significant upfront investments in land, mills, and equipment, an asset turnover around 0.4 is considered typical. It reflects the long asset cycles and high-value fixed assets involved. Lastly, biological assets account for 29.4% of total assets, which is a substantial portion. This shows the high dependency on oil palm plantations as a value driver for the business. Since these are measured at fair value under MFRS 141, any fluctuation in palm oil prices, yield assumptions, or discount rates can significantly affect total asset values. Understanding these ratios together give us a complete picture. Teck is capital heavy but profitable and has significant exposure to agriculture valuation risk. These insights are crucial for investors assessing both performance and risk exposure.
In conclusion, Teck financial reporting demonstrates strong compliance to MFRS standard. The use of fair value for biological asset and investment properties does not only increase transparency but also introduce valuation volatility. Overall, the company practices good governance by applying conservative valuation techniques and providing clear disclosure in its annual reports. Thank you, that's all from us.